Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the Profit by Friday podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. In the last episode, we talked about catalysts, the specific, structural reason a business is going to be worth more in 3 years than it is today, and how most investors confuse themes with real catalysts. Today, we talk about something most investors treat as background noise, leadership, and I want to challenge you on this immediately. Because if you have ever looked at a stock, seen a strong revenue chart, liked the sector, and moved on without spending serious time on who is running the business, you have been skipping the most important variable in the entire equation. Here is why leadership matters more than most investors realize. 2 businesses, same industry, same market opportunity, same starting capital, same product quality. You will be in completely different places. Not because the market treated them differently, because the people making decisions at the top were different. Capital allocation compounds. Good decisions made consistently over a decade build something extraordinary. Bad decisions made consistently over a decade destroy something that should have been extraordinary. The business does not know the difference. It just executes whatever leadership tells it to do. So when you invest in a stock, you are not just buying a business. You are hiring a management team to steward your capital. And most investors never ask whether the people they are hiring actually deserve the job. Let me give you the 5 things we look at when scoring leadership in the clear framework. The first is capital allocation track record. This is the most important one. Every dollar the business generates has to go somewhere. It can be reinvested into the business at high rates of return. It can be returned to shareholders through dividends or buybacks. It can be used to acquire other businesses. Or it can be hoarded as cash that earns nothing. The difference between a CEO who deploys capital into high-return opportunities and one who chases growth for its own sake is enormous over time. Did they buy back stock when it was cheap or expensive? Did their acquisitions create value or destroy it? Did they invest in what drives long-term earnings or in things that look good in a press release? Return on invested capital is the clearest single metric. A business that consistently earns high returns on deployed capital has a management team that knows what they are doing. Declining or mediocre returns often signals a team that is busy but not effective. The second is skin in the game. Does management own meaningful equity in the business, not options that vest regardless of performance? Actual shares purchased with their own money or earned through performance that is tied to long-term results. Leaders who own significant stock think like owners. They feel the same pain when the stock drops and the same reward when it compounds. As that alignment changes decisions in subtle but significant ways. When a CEO owns 1% of a $10 billion business, that is $100 million of personal wealth tied to the outcome. They are not going to make reckless decisions with your capital because they are making them with their own simultaneously. The third is behavior in downturns. This is the one most investors never check because it requires going back in time. But it is revealing. How did management behave the last time the business faced serious pressure? Did they communicate honestly with shareholders, or did they spin the narrative? Did they cut costs intelligently, protecting the parts of the business that drive future earnings, or did they cut indiscriminately to protect short-term margins? Did they use the downturn as an opportunity to acquire competitors at distressed prices, or did they panic and hoard cash? The best management teams get stronger in downturns because they have thought through those scenarios in advance. They know exactly what to protect and what to cut. They move decisively while competitors are still figuring out what is happening. If a management team has never been tested by a real downturn, that is not a reason to avoid the stock. But it is a reason to reduce conviction slightly until you see how they perform under pressure. The fourth is communication quality. Read the shareholder letters, not the earnings call scripts, not the investor relations material, the actual annual letters to shareholders. Here is what you are looking for. Does management describe failures honestly? Do they explain what went wrong, why it went wrong, and what they are doing differently? Or does every letter read like a highlight reel where only the wins are mentioned and the misses are buried in footnotes? A CEO who communicates honestly about failures is a CEO who sees the business clearly. Because to describe a failure accurately, you have to understand it. And understanding your failures is the prerequisite to not repeating them. A CEO whose letters read like marketing material is managing your perception. That is a red flag. Because if they are not honest about the small failures, you will not know about the large ones until it is too late. The fifth is longevity and consistency. Great leadership is not about a single brilliant decision. It is about making good decisions consistently over a long period of time. The longer the track record, the more you can trust the pattern. A CEO who has run the same business for 15 years and compounded shareholder value consistently through multiple economic cycles is a fundamentally different investment than a CEO who is 18 months into the job with no track record at the helm. This does not mean new leaders are automatically disqualifying, but it does mean the conviction should be proportionally lower until the track record builds. When all 5 of these factors are strong, the leadership score is high. And here is the thing about a high leadership score. It is a multiplier on everything else. A strong catalyst run by great leadership compounds faster than the same catalyst run by mediocre leadership. Strong earnings generated under brilliant capital allocation go further than the same earnings under careless allocation. Leadership does not just matter. It amplifies every other pillar and framework. Amateurs analyze products. Investors analyze the people running them. The product can be replicated. The people cannot. Go to ProfitByFriday.com for more. I will see you in episode 4.